we're going to discuss today is not sci-fi. It's happening right now. It concerns, well, probably most of us in the room. It will affect how we work, how we service our clients. And so let's dive in. So to start, I'd like to go back quite a bit in history, and I want to illustrate how progress has been accelerating throughout the history of mankind. And I think we'll try to take a particular interest in looking at population growth, GDP growth, but also the sectors, the primary, the secondary, the tertiary sector of the economy and how this has evolved through time. So bear with me a bit. We'll start back in the Stone Age from 10,000 years ago, so 10,000 BC. And what we see in this, obviously, picture of a Stone Age farmer was someone representative of his time, which was primarily using natural resources. The GDP estimate based on 2025 US dollars, and my estimates and all of the things you'll see in the following slides are from ChatGPT, so the numbers may be a bit fancy or crazy, but I think they're relevant to some extent for, I think, the idea we want to get through this. So back 3,000 years ago, or 3,000 BC, so 5,000 years ago, population of the Earth was about 50 million, GDP was about 10 billion, and 98% of our economy was based on the primary sector and natural resources. Now, fast forward about 2,000 years, we're now about 100 million on the planet. So in 2,000 years, we've doubled the population. We're probably about double or triple GDP, but primary sector is still about 90% of our economy. Now, fast forward again about 2,000 years, population has doubled again. We're about 200 million. GDP has doubled or tripled, and we have secondary and tertiary sector starting to pick up, but primarily we're still interested in feeding ourselves and focus on natural resources. Now, we are now in 500 AD, and so let's move forward to the Middle Ages, or the Dark Ages, probably not the period known to be the one with most progress. Population by 1400 is now about 350 million. So again, in about 1,000 years, we've probably about doubled the population. GDP is about 150 billion, and the primary sector is still 70%. Now, we get into the most interesting period for progress with the Renaissance era. So about 250 years where we see population growth really starting to boom, GDP accelerating, and where we really start to see a shift into our economy towards the secondary and the tertiary sectors, with the primary sector representing just about half of our economy. By 1750, the Industrial Revolution or industrial revolutions start to happen, and we see an acceleration of this growth continuing. So it's going faster and faster. In 150 years, we see GDP multiplying many times over, population reaching 1 billion, and we see this massive acceleration, especially of the secondary sector. Obviously, we're building lots of new machines at that time. And we're now reaching the 20th century, and especially the last 50 years of the 20th century, where this population boom is getting crazy, very worrisome for some people, where in 100 years, population has multiplied by 6 times over, and GDP probably 25 times. The primary sector is now only 6% of our economy. The secondary sector is starting to shrink to only 30%, and the tertiary sector is 64%. Within this 64%, this mysterious, at least it was to me until about 2 weeks ago, the quaternary sector is now about 19%, and it's included in the tertiary sector numbers of the economy. Now, Fast forward 25 years, we reach the now. Population is about 8 billion. GDP has, again, probably doubled. And the tertiary sector is, including the quaternary sector, is about 71% of our economy. Now, the quaternary sector is already about nearly 30% of our economy. Now, I'll fast forward one more time, and I've asked ChatGPT again to make some predictions 20 years from now. Population probably stalling in terms of growth, but still growing about to 10 billion. GDP is probably going to be around $200 trillion, doubling from today. The primary sector will continue to shrink. The secondary sector will continue to shrink. The tertiary sector, including the quaternary sector, is about 80% of our economy, but the quaternary sector is now approaching half of our economy. So I want to maybe do a quick survey in the room of who has heard of the quaternary sector. If you don't mind raising your hands. All right, that is very impressive. Again, in my confession, I had not heard of the quaternary sector up to about 2 weeks ago when I started to prepare for this talk. And yet, this is estimated to reach probably to be about half of our economy 20 years from now. So what is this quaternary sector? And one of the reasons that you haven't heard of this term is probably because it hasn't been taught in schools up to about the 2010 period. So if you are older than 35, there was a good chance you would never have heard of the quaternary sector if you didn't come to this talk today. So what is the quaternary sector? The quaternary sector is basically all the economy that relates to knowledge-based activities. It's research, it's innovation, it's information technology, it's data analysis. So it covers a lot of, obviously, the big innovation sectors, but namely, it includes mostly all of software, data, and AI, which obviously we're going to talk a bit about today. So let's focus a little bit on the last 50 years and what really happened. So when we reach the end of the 70s, as we'd seen, services had been transformed into a massive half and probably growing majority of the economy. Services were omnipresent everywhere, and that were driving the growth and the progress of our world. Now, what happened in the late 70s was obviously the birth of the PC revolutions, and with lots of PCs came about the software revolution, with lots of software being developed. Now, although if you had a PC, and initially not that many people had PCs, you could probably use Lotus Notes or Excel and some word processor software, but essentially software was really reserved to the business world. So software was taking up massively, but it was really reserved to, I would say, a B2B type of environment. But by the end of the 20th century, we had obviously two big revolutions that started to happen. The first one was the internet revolution, and the second one was the mobile revolution. So suddenly, by the end of the 20th century, what mostly any human on the planet could have at the fingerprints in their hands, and certainly at home, was access to all those digital services. They were handed software in their hands. It wasn't reserved largely to businesses. And so what happened, and which accelerated over the last 25 years, is a phenomenal disintermediation trend for a lot of the industries. Now, a lot of them we're very familiar and used to. So take retail, 5-7% of GDP. I mean, the Amazon story and e-commerce story is well known. Today, going to a store is something that, especially for the new generation, seems odd. But you see that across many industries. You see that in music, and Spotify, video or TV, and Netflix, payments, banking, you name it. So there's been a massive shift to empower the end user through digital services. And that has had, obviously, major consequences for our economy. And this is why the quaternary sector has been picking up so much and becomes prevalent in our economy. So we've reached the now, and what happened 2 to 3 years ago was, I think, a significant inflection point. When OpenAI released ChatGPT, obviously it was an amazing piece of software, it was an amazing product, but it carried out something much more important, which is the ability to transform digital services into smart or intelligent digital services. It also led the way for what we can discuss later, are AI agents. And so suddenly, the disintermediation is of a different nature in the sense that the end user can really be given advice and can be really helped towards everything end-to-end to the final asset that they want to purchase, own, or manage. Now, there are some industries that have resisted largely to the disintermediation and the digitalisation, So namely healthcare, legal, and the wealth management industry would be good candidates to date for a continuation of this disintermediation, which will probably continue in the other industries because it hasn't necessarily happened to the full extent that it can, but it's now going to happen to mostly any industries of our services. And this is why we're seeing the classic tertiary sector shrinking and a completely different era coming up, which we would call the era of the consumer, and this disintermediation story, putting the consumer in control. Now, I'm going to illustrate some of those consequences of what happened in the last decades and maybe make some projection. Again, I asked my best friend ChatGPT to give me some estimated numbers, so I don't necessarily vouch for those numbers, but they're probably good indication. So I asked ChatGPT to give me the most disintermediate jobs over the last 75 years. And so obviously we're picking up a bunch of things, agricultural workers going down. I'm not going to go through all of them, but let's take maybe the one before last, photolab developers. By 1990, an estimated 2 million people working in that field. By 2025, nearly zero. Within 10 years, the few remaining ones will probably be just artists. So we get 100% reduction. This story is well known. Jobs are changing. A lot of the new jobs are completely different from jobs that never existed before. Now let's go into the topic of the day, investment and wealth management industry. So I asked the same question to ChatGPT, and you see a lot of the jobs that are going to be or have already started to reduce in numbers. Again, I'm sure if you're specialists of that space, you'll see probably numbers that you might somewhat disagree with, but I think it gives us a good idea. Now, you see portfolio managers peaking at 180,000 people in 2010 and shrinking already by now and going forward. Now, this is probably not AI-related or partially AI-related. It's probably more the indexation and ETF growth of the industry. But you could still associate that with general progress and shift and the consequences into employment industry. Now, look at compliance and KYC. This is for people that work in this industry. We know we need to hire lots of people, do lots of KYC. It's very painful. And although you've seen massive growth in terms of those numbers, you start to see those numbers going down. And this has probably to do with the fact that a lot of those tasks can be now automated through different intelligent and productivity tools. Now, it's not all gloom and doom. If you look at the estimated number or jobs projected for the wealth and investment management industry, you're probably going to see an estimated of 10-15% shrinking. And the reason for that is because those industries are hiring new people. They're probably very different from the people that sit or used to sit next to you in the past. So I asked ChatGPT, what are the jobs that will be, the new jobs and the biggest numbers for this industry? Now look at those. For people who are not technology specialists, you might not know what those jobs are. For me, in working at Landytech, I can tell you those are the type of jobs we're hiring. So software engineers, data scientists, AI experts, cloud infrastructure, blockchain developers, UX designers. Yes, those are all technology jobs. And this is showing how much those industries are migrating towards a technology type industry and business. Now, moving on, I want to focus a little bit on each of those industry. They each have some interesting trends happening. So if I go back a little bit in time for asset management, and for those who are working in an asset management business, you're probably all too familiar with the pain of compression of fees that we've seen over the last 20 years. And I want to maybe show a little bit of history on the ETF and the innovation of ETF. The first ETF was created and launched in 1993. At that time, the average, according to Morningstar, which is probably US mutual equity funds, the average expense ratio for an equity fund was about 1.2%. By 2000, that number has not changed. The ETFs were managing about 65 billion, a big number, obviously from zero, but still a drop in the ocean of the size of our asset pool. Now, 25 years later, this expense ratio has halved to about 0.6%. The ETF industry is managing about $15 trillion. Now, if you look at ETF index fund, this is where the majority of flows are going from anywhere in the world. So if we do some projection, it is likely that those fees will continue to compress and that ETF will continue to dominate if you just look at the proportion of flows, and those average ratio will structurally diminish because ETFs tend to be lower than those type of fees. But what you see is the emergence of new products, such as tokenized ETF, which could push the price to zero. So I think there's some real questions to be discovered around the impact of those new technology and where those fees may go. Because today, asset managers are feeling the pain of compression of fees, and yet at the same time, the costs are increasing with more and more needs. It's mostly, obviously, staff, and it's about salaries going up quite incredibly. So there is massive pressure for the asset managers to find productivity gains and potentially job cuts. Now, if we look at the four main trends that we identified the asset management industry, I will go quickly through the first three trends. I'll dig a bit deeper into what I think is extremely interesting, the last one about blockchain and tokenization. Now, the first one, autonomous AI, what we're talking about here is, and this has happened obviously to a large extent already in some places, but portfolio managers, research start to use AI as co-pilot, as models to help in the investment process in the portfolio management. But we're going to see obviously an acceleration towards a fully autonomous, capable AI, autonomously managing funds. So no more portfolio managers. And the AI will be able to execute all the trade, to scan the market, to react to market condition much faster than a human can do. It's going to take some time, obviously, but this is happening, and it's happening now. Now, the second part is about, the second trend is about data. So obviously, data is the most valuable asset for an asset manager. AI will be parsing and analyzing ever-growing data sets, more complex data sets, and it will be able to identify and to react in an intelligent way, like no human can technically do. And then finally, AI is being used and going to be used more and more, leveraging cloud capabilities to do all the operation, compliance, and risk tasks. So there's massive amount of automation and AI leveraging throughout the different components of an asset manager. The part maybe I find more fascinating is the tokenization. So what is tokenization? We're talking about digitalizing assets. Now, before we go into tokenization, let's look a little bit, and I've used some research from our friends at Savills. Our next speaker is from Savills, to look at the world asset today. So as you can see on this picture, you get a lot of valuable asset everywhere. Debt at 130 trillion, equities at 100 trillion, real estate much larger than that. I mean, those are numbers from 2022, probably increased quite a bit since then, especially if you look at gold at 12 trillion. It's probably now at 16 trillion or something like that. So you see a massive size of our assets. Now, the question is, how much of those assets, how many of those assets have been digitized? Now, when I talk about digital asset, it's something that is essentially on the blockchain. Now, most of you are certainly familiar with cryptocurrencies and Bitcoin, and that's the large amount of digital assets today. Probably about 2.5, 3 trillion assets in cryptos. But most of those are digital first. They're cloud native. They're digital native. They don't represent an existing asset. They're new asset, somewhat smart, created for zero and now worth 2.5 or 3 trillion dollars. Now, what I'm interested in today is to look at the tokenization, the digitalization of those assets. So the coin term is RWA for real-world assets. And today, real-world assets are estimated around $20 billion, maybe up to 100. And this will be mostly some debt digitalization of funds. There's probably an unknown number in the real estate private world. But this number is tiny. Now, if you remember the ETF story, by 2000, ETF were 65 billion, probably something close to what we have today. If you keep this idea of the acceleration of our trends, of our progress, it may take us less than 25 years for those assets to grow in size to the 15 trillion that the ETF market is. Now, what is tokenization? So again, tokenization is very simple. We want to digitalize, so it's the process of converting a real-world asset, could also be applied to a digital asset, into a blockchain-based token. So that token represents on the blockchain the ownership of that asset, could be rights, shares, and then this token can be traded, transferred, managed in an electronic way through the blockchain. Now, what can be tokenized? Well, everything can be tokenized, even things probably that shouldn't, like NFTs. But we are effectively starting to tokenize more and more stuff. So currencies can be tokenized, and that essentially is what we call stable coins. So if you look at stable coins today, it's only the US dollar, the rest is tiny. So you have tokenized US dollars. You can tokenize or digitalize commodities. Today, mostly gold, but you can have digital gold. But you can tokenize everything. You can tokenize equities, you can tokenize bonds, you can tokenize art, funds, and even real estate. Again, this is very nascent, and based on projections of 10 or 20 years, I'm not saying this is going to happen overnight. So why do we want to tokenize those assets? So there are lots of benefits. There are also lots of inconvenience today in a very biased way. I'm not going to talk about all the problems and the issues. I'm just going to highlight some of the benefits. But the idea is that you get improved liquidity. Through fractional ownership, you can actually sell 5% of your house. You can create a very small value unit of things that were otherwise very expensive, which means you can grant global access to anyone without bank account to buy any portion of anything in the world. You can trade at much lower cost. So if you work in any of the custodian, administrators, agents, you might not like what I'm going to say, but yes, you don't need all those intermediaries. And so it goes very fast, it goes very cheap, and it's very efficient, and it's empowering the end client directly. So the end user can control buy and sell at no cost, effectively, immediately. There's no settlement of X days. You get full transparency. You get an audit of everything, so you can actually trust. Now, when we talk about security and trust, clearly there's lots of clouds and there's been lots of issues, and I'm not diminishing those. But clearly the benefits of tokenization for the end consumer, I think we all ought to be consumer-centric, are quite amazing. Now, who has started to tokenize funds in the asset management industry? I think through this slide, what I want to show is both agree that it's tiny. There's no point arguing on this. But as you can see, the biggest names in the industry have started to tokenize funds. So I think the first, what is supposed to be the first tokenized fund was launched in April 2021 by Franklin Templeton. It's called, it's FOBX, Franklin On-Chain US Government Money Fund. Most of those big funds are typically money market funds or currency funds. Today, it's about $700 million. And this was a direct-to-consumer access. BlackRock launched last year, about a year ago, its Beetle, I don't know if you're supposed to pronounce that acronym. Today, it's about 1.4 billion. So those are a significant number. They obviously are tiny compared to lots of other things. But I think what's interesting is to see that they're picking up and that the biggest names in the industry are not afraid and they are getting involved. Now, those were natively tokenized funds. You can't access those funds in traditional channels. You can't buy shares if you don't go through the blockchain. Now, a lot of other fund managers are getting involved by tokenizing some access to their existing funds, which is probably the way to accelerate the tokenization of funds. So you get KKR, Hamilton Lane, Apollo, Aberdeen. You get lots of people starting to tokenize. The numbers are probably small, but you start to get everyone putting their name out there and offering tokenized funds. So maybe as a signal for asset managers in general and for maybe asset owners looking to buy, this is not mainstream yet, but this is really endorsed by a number of big names. Now, maybe just prediction-wise, I want to jump into some crazy numbers. BCG about 2-3 years ago forecasted that this industry will go to 16 trillion, so real-world assets by 2030. I think they got a bit too excited, but McKinsey last year did some interesting research with a base case of about 2 trillion, and it all depends on the early adoption, and we can talk about this in a second. Standard Chartered forecasted 30 trillion 10 years from now, so which is very consistent with what we've seen, for example, in the ETF industry. Now, why would it happen? Why would people start to buy those digitalized assets? So I think the first big catalyst that I think everybody should be watching in terms of maybe the biggest indicator of this trend is CBDCs, so central bank digital currencies. In a survey about a year ago, 94% of central banks declared that they are actually doing work to build CBDCs. 94% of central banks. A few ones like Nigeria, Jamaica, and so on have actually launched those, but all the big central banks, and namely China probably, and obviously the US to follow suit, are going to be launching CBDCs, which is going to be a legitimization of this whole industry that will probably accelerate massively the adoption. And specifically for RWAs, this means that you can actually settle in a reputable or trustworthy currency from CBDC. So it's very likely that this will boost those RWAs. Now, there's also a couple of other things that are a bit more technical, but today you have about 200 billion in stable coins. So this is people buying digital dollars. Now, when you buy digital dollar, you want to do something with it. And you don't want to lose the digital aspect. This is why you did it in the first place. But you're going to seek yield and income. You want your money to work for you. So you need to buy stuff. And so they're desperately seeking for yield-enhancing investment capabilities. So they want to invest in those RWAs. There's also a last one, which is the DeFi protocol, total value locked up, which again is more used for collateralization requirements. And there's about 100 billion, again, seeking this. So there is a good chance that this will be structurally pushed. The growth of this trend is going to be pushed quite actively, and expectations are pretty high. Now, I know I'm running out of time, so I'm going to jump to the wealth management industry. And I want to go back quickly to fees again in the wealth management world. So rather than looking at back in time, I've looked at three different environments. The traditional wealth manager, you can say it's the past, or you can say it's, for a lot of people, the now. The digital platforms, which should be the now, and maybe what the future is. So what you see is that custody fees, which could be charged 10, 20, 30 bips by traditional banks, is dropping to nearly zero through digital platform. Execution fees are dropping as well. Advisory fees are probably not really provided in an efficient way by any of those platforms. And lending is probably better with digital platforms, but still largely provided by custodian banks. Now, what you see in the next kind of potential trend and progress is that through on-chain self-custody of tokenized digital assets, you pay zero in custody. You trade instantly for zero cost. You probably can run advisory mandate through AI and AI providers that can probably, or specialized investment management AI providers, which will probably push the price down to 10 or 20 bips. And then the lending is also near zero if you're using the tokenized world. Obviously, from an analytic perspective, if you use consolidated app, then you're going to get the full consolidation information. So this is how we're seeing the shift, and clearly a lot of wealthy investors and family are still largely allocated to the traditional wealth manager, but there's massive pressure. I want to say a few words on what we mentioned in the past about the era of the digital owner. And maybe to start, I think there's a striking number, which is how much wealth is going to be transferred in the next 10 years to the millennials and the Gen Z. So the estimation is probably about $80 trillion. Now, some of you may be millennials or Gen Z, but millennials and Gen Z typically have a very different, well, they receive different education. They might not know the same tools and might certainly know some very different tools. They use to a seamless digital experience. They want easy access. They want complete ownership. They want self-service. They want AI personalization. They want a digital experience, because this is what they're experiencing in social media, in any type of current digital services. And so I think this is really leading the way to what we are going to call the wealth super app. Just going to jump a bit forward, three more points. So first, what we would call the rise of the super app or the wealth operating system. Basically today, if you look at ultra net worth wealthy asset owners, they are exposed to lots of disconnected platforms, banking platform, asset managers platforms. They receive lots of PDF, Excels, and when they want advice, they need to call somebody. This is still largely the old model, and they lack control and access, and they have really a poor experience. The tomorrow's super app will combine all those data sources into a centralized platform, and the AI will be able to give advice, insights, and the end user will be able, through an assistant or an agent, an AI agent, to direct and decide on everything that he wants to do. So AI agent, and I think this is the point that is interesting to place in the timeline, is that in 2022, when ChatGPT moment arrived, this was offering some very interesting capabilities, but then the plugin starts to come in, and then probably only about last year where the AI agents really starting to develop. So I don't know if you experiment with ChatGPT, if you talk to ChatGPT through like speech to text, but this is progressing very fast. So you can ask ChatGPT and talk to ChatGPT like you would to a human. It's a bit scary if you get used to it, but this is really happening right now. And so I think clearly the future is really related to AI agent. This is how the consumer is going to interact with those digital services. And this is, I think, it's going to apply to wealth management by and large. Now, there's one big bottleneck that specifically applies in the wealth management world, and that is what we would call the data wall. Now, data is a major issue. You have those bank custodian information, you have those investments, those private investment with no book of records, and so you need to get this data. Now, banks have started to offer APIs in the open banking world, but that is not covering custodians like private or investment, and this is unlikely because they're not really working on this and they don't want to do it. So we need to break this wall, and to do that, what we need is to create a private store, a store where we can ingest all the data in a secure, private way, and then we need to ingest all the information coming from any of those sources. We need to clean the data, and only then will the AI be able to analyze this data and deliver all its value. So today, without good data, the AI is essentially powerless. So I'll just finish up quickly. I'll make some predictions for the next 10 years. I think the first one is that the best asset managers will become technology companies. If you take the biggest asset manager, BlackRock, it's already happening. Obviously, they developed Aladdin, they bought Preqin. They actually want the multiples of technology companies versus asset manager companies, but they also know that the future is through technology. So within 10 years, BlackRock will be considered and will be effectively a technology company. Private banks, obviously scared in their custodian advisory business, will need to embrace those new technology, partner with fintechs, or they are going to be losing out. I think we are going to see the digitalisation of assets, the tokenization, becoming mainstream. Might still be a minority of our assets, but it will become mainstream and be fully used and accepted. I think there's a big question we didn't discuss today about regulation, and clearly the regulation framework of every country in the world is completely disconnected from the reality of AI, and we need to do something about regulation. Countries will react probably differently and then follow the leaders, but clearly the ones that are most friendly to AI will be the one where the biggest changes happen. And then finally, I think ultra high net worth will manage their money, their investment wealth, their wealth, largely or entirely digitally. Now I'll just finish that slide with some key takeaways for asset managers. I would encourage asset managers to discover and experiment with tokenization. I would suggest that they build a partner with data providers and technology providers, and certainly that they invest in AI for their investment management capabilities. As for wealth managers, I think wealth managers and private banks needs to embrace technology. They need to engage in DeFi, decentralized finance, and digital assets. And I think they need to really support true consumer-centric experience. It's not about delivering a great app for your bank and for the account of your client at your bank. It's about delivering what matters for the end client, which is a consolidated application that gives the end user everything he needs. I've put lobbying the regulators. I think everybody needs to lobby the regulators. And finally, on asset owners, my biggest recommendation, I'll probably stick to that one, is get your data sorted. You need a single source of truth. You need a secure single source of truth, and you need to be able to ingest this data and consolidate all your data in one place. Sorry, I'm done. Thank you for being a bit too long, and thank you for your time.